In almost every profession on Earth, effort equals output. You put in 8 hours of sweating, hammering, or typing, and at the end of the week, you receive a paycheck directly tied to that continuous exertion. In the markets, that same hard work mentality operates in reverse. Applying manual labor logic to a system of probability creates a mechanical mismatch between your effort and your results. Financial markets frequently enter phases of chop, periods where prices bounce erratically with no clear trend. In these environments, standard trading strategies lose their mathematical advantage entirely. Unlike a traditional employer, the stock exchange does not compensate you for clocking in. The market does not owe you a profitable setup just because you sat down and stared at your screen for 6 hours. This creates an intense psychological friction. Sitting in front of completely dead price action for hours induces a specific kind of agony. The human brain craves stimulation, and the temptation to press a button and do something becomes nearly overwhelming. This inability to tolerate boredom is exactly what births the low-conviction trade. It's a weak, unproven setup that doesn't actually meet your criteria, executed for no other reason than to scratch an emotional itch. Yielding to restlessness triggers a cascade of mechanical failures, eventually stripping the gears of a functional risk management system. To understand the damage that forced action causes, we have to look at the math behind trading without a verified edge. Negative expected value ensures that over a long enough timeline, a sequence of 50-50 bets in a directionless market forces the account balance into a jagged downward slide. Even if those forced trades manage to break even on the raw price, they still lose money. Every transaction carries broker fees and crosses the bid-ask spread, applying an ongoing tax on your capital. This cycle of minor, repeated losses combined with spread fees creates a death by 1,000 cuts. It steadily drains a portfolio dry without the need for a single, dramatic market crash. By forcing trades that lack conviction, you mathematically guarantee the erosion of your own capital. You effectively become the primary threat to your own trading account. But the financial ledger only reveals half the damage. The second layer of destruction directly targets the trader's mental capital. When you are trapped in a weak trade, you still have to manage it. You burn hours staring at ticks, trying to micromanage a bad entry, which spikes stress, breeds frustration, and strips away your objectivity. That mental exhaustion leads directly to the final and most severe penalty: opportunity cost. Because your purchasing power is locked up and your mental bandwidth is consumed by nursing a bad position, you are paralyzed when the market finally presents a clean, high-probability setup. Forcing a trade traps current capital in a losing position and blinds the trader to the high-probability setups that follow. To survive, you have to discard the idea that sitting out a market session is an act of laziness or passivity. In this environment, doing nothing is an active decision. It is a deliberate choice that requires immense restraint and focus. Holding your capital safely on the sidelines while the market chops sideways is the deployment of a strict defensive tactic. It demands a high level of mental toughness to watch red and green numbers flash across a screen all day and consciously choose to withhold your participation. Mastering this specific type of inaction is the only mechanism that preserves your resources. It guarantees that you are fully funded, rested, and objective the moment the odds finally shift back in your favor. This points us to the overarching philosophy shared by consistently profitable professionals. A lasting career in the markets is rarely built on a genius ability to predict a next massive price surge. Long-term survival depends on a filter that blocks erratic market noise, allowing only the most refined, high-probability setups to reach the portfolio. Practicing extreme restraint serves as the ultimate protection, ensuring your capital is never exposed to random fluctuations. We can call this the discipline of the idle hand. It's the cultivated ability to read the tape, accurately diagnose a weak market environment, and confidently step away from your desk. There is a profound psychological victory in closing your trading platform at the end of the day, knowing you didn't execute a single action. You didn't give a single cent back to the chop. Because when the market is erratic, unreadable, and offering you absolutely no edge, the most profitable trade you can possibly make is no trade at all.